Here in the fifth and sixth section, we'll be introduced to a few more entries and inventory errors cases and how accountants usually deal with these inventory errors, okay, and adjustments. So at the end of chapter 5, we talked about one adjusting entry. Remember that it's different from service type of business. At the end of the season, regardless of whether a corporation is using perpetual system or a periodic system, at the end they always want to do a physical count of inventory, the dollar amount, the total value of inventory in the warehouse, and see if it matches with what's there in the system. So in the last part of chapter 5, we talked about this journal entry. If there's a difference between, let's say, what's there in the system and what's there really in the warehouse, the difference is we would journalize an entry do an adjusting entry that looks like this for inventory differences between the system and actually the value in the warehouse. Now this is another adjusting entry. This is called lower of cost or market rule. So this entry here doesn't necessarily happen in each and every corporation, and doesn't necessarily happen in each and every season. But basically at the end of the year, before accountants issue yearly financial statements, they want to make sure that the inventory cost, meaning the original historical cost of inventory, is at a point that's lower than the current market price. Okay, so for example, if an item earlier was purchased at $10,000, usually for most of the products, for example, like daily living products, there's things that you see in grocery stores and regular retail stores. Usually the product, as time goes by, will slightly increase the price of this product. Okay, but in some cases, for example, high-tech based products, technology-based products like computers, notebook, iPad, iPhones, you can expect that after a few years, whatever was the high-tech product that you purchased earlier would not have the same value a few years later. Okay, so this journal entry would suit for some of those products or even other products. If, as time goes by, the retail price of those products gradually decrease and to a point that is lower than your original purchase cost, then accountants will have to journalize this entry to match up inventory's value with the current market price. We can also say this current replacement cost. Okay, once again, if earlier a corporation purchasing a batch of products, let's say they're worth $10,000 in the beginning of this year, January 1st. Okay, now later on they definitely want to resell this product to their customer, and let's say they mark up a price that's worth $20,000. So this was the retail price. This is the sales price that they can get from customer. This is the original purchase cost. Okay, you purchase something at $10,000, you sell it to your customer as $20,000. So let's say this was a box of iTouch or iPods. Later on, after 5 years, the current market price gradually decreases to a point that it reaches $12,000, and then later on perhaps $9,000. Let's say this was 3 years later. So once it reaches a point that is lower than your original purchase cost, you will have to reduce the inventory value by that $1,000 differences with this journal entry. Okay, so basically the concept here is that we want to exercise accounting conservatism principle. Remember in the beginning of the chapter we talked about 4 different principles. And accounting conservatism relates to estimating expenses and liability to the highest possible level. Right? So the principle, the underlying core is that we want to measure up and make sure that inventory value is not overstated. Meaning that if the current replacement cost is only $9,000, you cannot represent $10,000 on balance sheet for this asset. If currently the market really already recognizes that the product is no longer worth that much, it's only $9,000 or even lower than this, then we will adjust the differences between your original purchase cost and the current market price. Okay, so this is exercising the lower of cost or market rule. You'll be comparing at the end of the year for all your inventory, the original historical cost and its current market price. Usually market price will be higher than the original historical cost. But in some cases for some of the products, if their current value has decreased to a point that is lower than your original purchase price, then you capture the differences between the two and reduce inventory's value. Okay, so this entry here, the example is that earlier you purchased an item that or a group of the same type of products that were $3,000. At the end of the year, currently the market price for this product decreased to $2,200. Okay, so now the difference is here. Usually the case, this will be lower than retail price, the market price of this. But if this is not the case, if it's the opposite, market price, you can't sell the product at $3,000 anymore because all your competitors are selling the product at $2,200. And you capture the differences here and reduce your inventory value by $800 to match with the current market price. Okay, so the replacement cost here is the current market value for that product. Right, so after this journal entry, if the original inventory value is $3,000 and you journalize this entry to reduce $800, so when you would see on balance sheet for this inventory account, I just snapshot the inventory account only, not the other asset account, you would only see $2,200 here. Okay, and this reduction from $3,000 to $2,200 is solely because of the market price has reduced to a point that's lower than the original purchase cost. Not because we sold out $800 worth of inventory. Okay, it's because of this adjustment, lower of cost or market price. Yes, I just passed around 4 piles of practice questions to make sure you choose your own. Okay, you should have 4 from 4 lectures, 4 practice questions. Okay, so this journal entry here really looks exactly the same as Chapter 5's adjusting entry that we talked about. When we do a physical count of the actual inventory and see if it matches with what's the inventory level there on the system. These 2 entries look exactly the same, but it means different. Okay? But so for the problems that you see, if it tells you that this case here, if it tells you the current market price is different from your original historical cost, you would journalize this entry. But if it tells you that the current value in the warehouse is different from what's there on an online system, you would also journalize this entry. Okay, so these entries are, in a sense, they're both adjusting entries, adjusting inventory's value. The key point here is that we want to make sure corporations reflect inventory account that really matches with what they have there in the warehouse and the actual value. Okay, but they share the same entry. When you debit and credit, the accounts are the same. Just the values, how we take care of them, difference depends on problems. Differs depends on problem. Okay, other inventory cases, if there were some cases of inventory